All right. I think we are live here. Let's double. Okay, great. Welcome everyone to the live stream today. It's November 17th, 2025. We've got markets down across the board. Excuse me. Dow is down, NASDAQ is down. Crude is down, silver and gold are down, Bitcoin, everything is down across the board today. So we've got, we need to look at, how we can protect ourselves from the downside. And there's a few ways to do that. I'm going to give you an example with this stock, Big Bear, because it feels to me like there's this, I don't want to say definitive shift in market sentiment, but it sure feels like it's kind of borderline shift because of the volatility. We've had times today where we've been, the markets have been up like 80 points or so, and I'm referring to the NASDAQ, and then down 200 plus. And that's literally like what we're dealing with now in terms of on a daily basis, what we're seeing. Let me see if I can get this whole chart in here. And I just have to do that. Okay, so Big Bear chart, you can see it's riding that 200 moving day average. We need to see it hold above the 200 moving day. It's literally just hovering above it. The stock 200 moving day, as you can see, is $5.38. The stock is at $5.45 per share. So there are a few things you can do here with, if you're holding Big Bear. I mean, first of all, you can simply ride it out, right? Like you can just hold on to it, let it do its thing up and down, and then, that's one choice. But there's other choices that exist with option contracts, and there's a few things you can do with options. So if you own the underlying stock, you can sell a covered call against the underlying stock. So, and what I'm doing is I'm going out all the way out to either 2027 or 2028. So these are leaps, right? Long-term option contracts. And so let's use this as an example. These are the leaps that I personally have on this stock. So I have the January 15, 2027s, and I sold the 10 calls. I sold them. So I received, I think it was $2.02, something like that, right around $2 at that time. This was last week. Oh, you're not seeing my screen here. Let me make this a little bigger. Here you go. So it was these 10 contracts, and they were trading, right? The bid at the time was trading at $2.02. So I received that back per every 100 shares of stock that I own. Now, if I were to want to close the position, because now, I'm on the hook to for my stock to potentially be called away at that $10 strike price during this time, until January 2027. So 14 months. Because it's the 15th of the month. So 14 months, if the stock goes above $10, there's a really good chance it's going to be called out of my portfolio. So I have a choice here. I don't have to hold these contracts to expiry. Don't have to do that at all. I can there's the expiry January 15, 2027. I can simply trade the contracts so that I can free up my stock position. So how would I do that? Well, because I sold to open the position, I would have to buy to close the position, right? So I've sold to open, I received money in return, and in order to close out that contract, I'd have to buy it back. So whenever you do this type of strategy, make sure that the the option premium that you brought in on the bid side initially, you just kind of tuck away so that you can use that to buy it back. Now, that's one way, right? Selling a covered call, instantly you receive money into your portfolio. There's another strategy that works when you have a stock going down, which are puts, right? Put strategy. And puts go up as the stock goes down. So what I did was I did a shorter duration put, because now you're not receiving money back. You are spending money. You are investing money. You're paying for these contracts. And I bought I think it was, December 19, 2025. So I bought the put contracts, and those are up. As you can see, they're up nicely today. But my return hasn't been anywhere as good as the calls that I sold. So if you have in mind to hedge your position with options, I really am thinking that, I bought the January 16, 20, those puts. I really think the best way to go about it is to sell a covered call, because for several reasons, like you're receiving money instantly back into your portfolio. You already have the underlying stock, so there's no risk there. Like the worst case scenario, the stock is called at the strike, so you sell them obviously at the strike. Let me go back to the calls. And let's use this as the example, January 15, 2027. So you've got here we go, 10 calls. Now you can go out, heck, there's strike prices at $17. Like that's pretty sweet too, to look at, hey, am I willing, the stock's at $5.42 right now. Am I willing to have this called away at 17 by January 15, 2027? Well, that's more than 3 times your money, right? More than 3 times if it's called away at $17. So I don't think that is such a bad way to go. Now, these are way out of the money, so they're not priced as good as the at the money options, right? You can tell the difference. You'd be selling a 17 contract at $1.17 instead of $2.55. But if that doesn't bother you, then you could just you could actually hold these contracts until expiration, let it expire worthless, and you just pocket that premium. Right? Like as long as the stock is $17 or above, it has to be above that strike price for it to not be called away. If it's lower than 17 in this time period, like if you really think, I don't know what's going on with this market, like if you think that we're entering into a bear market territory for an extended period of time, then you can trade these contracts and sell them instead of holding them. So you can make money that way as well. So you have some flexibility with these. If this is confusing to you and you're like, I don't know what the heck this guy's talking about, consider joining our options program next year. We're starting a brand new group beginning of January. It's a great way to kickstart the year. Your tuition is very reasonable. You have to start with 50,000 US, and then we take students up to 250,000 US. So you have to have the ability to buy US stocks, but we guarantee that your tuition is covered by your option premiums, because we're selling the contracts every single week. So I'll teach you how to do these strategies, It's a way to learn with a money back guarantee. Doesn't get much better than that. So if you're interested in that, reach out to us. Let us know in the comments or in chat. I'm happy to have a call with you and see if you're a good fit for the program and if it's a good fit for you. So that's what I've got today. You know, we've got on Big Bear that idea to trade these contracts. We've got earnings coming out this week. And Wednesday after the close, NVIDIA. This is a big one, all eyes on NVIDIA. There's going to be a couple revealing earnings reports that come out as well. Home Depot, let's see how well people are doing spending money on capital improvements for their real estate. And Target, another one before the open on Wednesday. Target, TJ Maxx. These two are going to be interesting to see, you know, what is the spending power for consumers right now. You know, we've had companies come out like in McDonald's and some other fast food companies and have horrible earnings because people aren't spending money at these places anymore. But we've got Walmart on Thursday. So I think this is a really pivotal week with earnings and to get a really good assessment of people's ability to spend. Are they spending? Are they not? Like, what are they doing? And, you know, here's another one, Ross, there we go, on Thursday after the close. So this is pivotal. Now we apparently have the US government going back to work. Is that right? Is it happening this week? I don't know. There's a lot of uncertainty with that part of it. And some talk about some stimmy checks going out to folks who are earning less than $100,000 a year. We'll see if that happens. I don't know. I don't think there's real clarity around that at this moment. But nevertheless, we've got a very challenging stock market, and I don't think it serves to just buy and hold here. I think you have to be a little more proactive with your stocks, and because, you know, with these option contracts, like there's just so much opportunity with this level of volatility. Take advantage of it, make some money with it. And if you're not sure how to go about it, just connect in with us, and I'd love to have a conversation with you to see if you're a good fit for the new program coming up next January. All right, everyone, have a great week, a productive week, successful trading week. Go with the momentum. Like, we know the trend is our friend. You can always make money on the downside with stocks. In fact, I've often said stocks take the stairs up, but the elevator down, and you'll make more money faster in a down market. So don't be afraid of this market. Use some strategies that will help you navigate the market. And again, selling covered calls, leaps, long-term calls, and or buying puts against your stocks or against any stock, really. Once you're buying the contracts, you're in control of that contract. So you're not going to have stock called away from you or put to you because you bought it, but you can simply capitalize profit on that particular put contract. If you're seeing some stocks that are way overvalued, you're like, I know that thing's going lower, right? I'm just watching a couple across my screen here. I think Microsoft falls into that category. I think Apple falls into that category. You know, I just think there's some real opportunity here. NVIDIA is super uncertain. Like, it's taking it on the chin today, but we'll see what happens with earnings. You know, your guess is as good as mine. So anyway, have a great week. I'll see you next Monday.